Well, hey there, everyone. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from kind of a classic winter afternoon here in Redmond, Washington. Um, Decent weather. I was actually, speaking of decent weather, I was actually down in Los Angeles, down in Southern California over the weekend. I'm on the board of a music school. It's really a summer music camp based in New Hampshire called the Walden School. And it was a ton of fun to get down there. Number one, to get away from our current weather situation here in the Pacific Northwest and get to some sunnier days. I'm sure those of you in the Northeast, that sounds pretty good. It was actually a heat wave when I was down there. And although I personally didn't experience any horrible heat, it was actually quite lovely. But it was a nice break and a pleasure to be doing some things other than charts for a little bit, remembering the important things we do outside of investing. I always tell people, especially with my premium members, when you're getting caught up in the challenges of investing, when it feels like the market is difficult to get a read on, when it feels like you're struggling a bit, always important to take a big deep breath, a big step away from your monitor, and reflect on why you're spending all of this time. There's your why is something meaningful to you and probably just you. Make sure that you write that down sometimes. Make sure you reflect on that. That's what makes the challenging investing days a little less painful. We're live streaming a little bit late here. Sorry about that. To be totally honest with you, my wife is going through a number of things. She's a substitute teacher and is a musician and was running between things. And I had a little window of time to see her. So I selfishly started off a little bit late so I could have a few moments with her. So I hope you'll give me that room. With that in mind, shall we look at some charts together? Pretty interesting day. And it was interesting in a couple reasons, right? We had a big gap higher out of the open, but the most of the trading day was pretty range bound, right? We basically spent the entire day between 66.80 and 67.20. I mean, pretty narrow range. So besides that opening gap, this was an unch. This was a sideways day. So the headline is the S&P closed up 1%, closed right about at 6,700. That is true. The headline is going to be the NASDAQ was up over 1%. That's true also. But as a technical analyst, just looking at that one data point isn't enough. I really want to think about how we finished the week on Friday, how we opened today, how we traded. And that's sort of a standard operating procedure for a Monday session. And so while on the surface, this seems encouraging, was there a bunch of accumulation through the trading day? I would argue there definitely was not. After that gap open, we basically finished the day almost exactly where we started trading here on Monday, March 16th. We'll, as always, have three parts to the show. We'll look at some market updates here today. We'll look at some the heat map, which is a great way of just understanding the general complexion of the market. Not a bad day in terms of breadth conditions, as you'll see here in a few moments. And then we'll look at some charts that I have hand selected through the course of the trading day to review with all of you. Let's go to it. So the S&P, as I mentioned, up 1%, 66.99 is the official close. A couple decimal points after that, but that's kind of the story. We're right at 6,700 here, so still below our short-term breakdown level of 6,800, still well above our kind of ultimate line in the sand of 6,550, and that's where we remain through the course of the day today. The NASDAQ outperforming a bit, finished up about 1.25%. Mid caps, small caps, all up, but up a little less than the S&P 500. So overall decent day for the major indexes in terms of today's returns. I'm noting that like mid caps, small caps finished at the lows of the day. So again, in terms of general takeaways for today, that's something that I think is hard to ignore if you look at today's price action. The VIX was down almost 4 points today. So on the good news scale, right, we finished the week on Friday with the VIX finishing above 27. That's pretty high when you look at the historical averages for the VIX. We've certainly had a pretty volatile go of things here so far in March. But we can see Monday today on the left half of the chart, kind of drifting lower through the course of the day. So down almost 4 points. We're still above 20 though. So a VIX above 20, by my reading, is still a high volatility environment, which is where we remain. Looking at rates, we can see the bonds rallied today, which is a bit of a shift. We've generally been observing higher interest rates. Of course, this week, one of the key moments to figure out will be the Fed meeting, right? That starts tomorrow and goes through Wednesday. So Wednesday afternoon, we will have the official announcement. Again, the market pricing in almost zero chance of anything but rates remaining the same here at this March meeting. I think the most important takeaways will be the press conference afterwards with Chair Powell's prepared comments, and then certainly the Q&A. That's where you have a lot of volatility as investors parse every syllable just to see if there's anything new in terms of expectations. The dot plot, which is sort of the projections of the different Fed governors and where they see interest rate policy going through the course of 2026. There'll certainly be a lot of questions about that trajectory, when we may see a new rate cut from the Fed. But again, no chance at this point of that happening at this week's meeting. So as bonds rallied today, the TLT was up just under 1%. You can see the 10-year point lower, so the 10-year yield down back below 4.25%. Long bond yield back below 4.9%. Dollar index down slightly. That's an important one to notice as well. We have been observing a stronger dollar environment here in March. So as we can see, right, a bit of a mean reversion from the trends we talked about through all of last week. Last week, it was weaker stocks, weaker bonds, stronger dollar. Today, it's stronger stocks, stronger bonds, weaker dollar. So literally flipping the script that we've observed in recent weeks. Now, part of that story is that crude oil prices actually came down today, which was a welcome break from the general trend that we've observed in crude oil prices. I did grab the chart of crude oil to dig into just a little bit today, but the USO, which is a crude oil ETF, down 4% today. Natural gas, gasoline prices all down as well. So that whole energy complex moving back lower. To be clear, oil prices have been trending higher. Certainly not unrealistic to expect crude oil going up before this is all said and done, but for what it's worth, down today, and that's worth noting. Kind of mixed results here, with gold basically flat for the day, sold off in the morning session. The afternoon was a little stronger. Silver prices actually finished toward the highs of the day. Copper prices higher. So metals up, energy down is the general takeaway in the commodity space. Another interesting bullet point in today's show: strength in cryptocurrencies, right? We're seeing Bitcoin up over 74,000 today. That's after sort of chopping around, holding 70K on Sunday. And now Monday, as the U.S. equity markets open, Bitcoin basically rallying through that period. So getting really close to 75,000. That was the level where I kind of set an alert saying if it gets above 75,000, maybe I take a nibble here and revisit that. I don't have a Bitcoin position at the moment, but you're seeing a lot of green here in those cryptocurrencies across the board here. Top 10 coins on stock charts, all in the green. Boy, on the equity side, when was the last show where we had all 11 S&P sectors in the green? It's been a while. I can't remember this happening in March. I might be wrong on that, but it's been a minute since we've had this sort of pattern here. Technology back at the top of the list with the XLK up 1.5%. Consumer discretionary, the XLY up 1.2%. Industrials, financials, healthcare, all up about 0.8% for the day. The worst performing sector still up, just up less than 0.5%. You have consumer staples up about 0.25%. Energy and materials, again, at the bottom of the list here. So as we're thinking about what happened today, I mean, the way I would generally describe this day is a beautiful counter-trend bounce after last week, which is a pretty negative week in so many ways, in terms of breakdowns of support, in terms of breadth data getting more and more negative. Here we're getting positive price action, positive sector movements, and as we'll see here in a moment, positive breadth, which is something we haven't seen a lot of in the month of March so far. On the NYSE, about a 2-to-1 ratio, 68% advancers to 29% decliners. On the S&P, even better, about a 3-to-1 ratio, 76% advancers, 24% decliners. So breadth pretty good today. So the question for the remainder of this week, is this just a taste? Is this the appetizer for a bullish meal we're going to enjoy together every day, coming in here for the market recap show, celebrating a nice day in the green for major equities? Or is this just a pause? Is this a pause in the downtrend before the deterioration resumes? Certainly midweek, we're going to have a potential catalyst from the Fed meeting. Again, not a real chance to speak of that the rates Fed target rate has changed or lowered this week, but but certainly there could be some expectation of some relief there, right? Lowering of rates in subsequent meetings. Our market trend model, as we outlined for our premium members over the weekend, now bearish on the short-term and medium-term timeframes for the S&P 500 and indeed for all the major U.S. indexes. We haven't had that configuration since spring of 2025. You might have seen the banner right at the intro of today's show. We will be doing a free webcast this Thursday. I'll share some more details about that in a moment. But we will be talking particularly about the market trend model, what it means that medium-term time frame is turning negative. I think that's meaningful. I don't think that's an ignore this moment kind of thing. I think this is where you need to internalize and appreciate what the potential severity of that move. We'll talk about that on Thursday's webcast. We'll share some details in a few moments, so you can sign up for that free event if you like. Looking at the Magnificent Seven and Friends, I did a video for Stock Charts TV. I hope that's posted by now, and if not, it should be there pretty soon. Digging into these 8 charts, the Magnificent Seven and Friends, and what I call them. It's actually a lot more than 8 as I'm looking at the tickers. 9. I added a couple random ones over time, but so it's more of like the Magnificent 7+2, I guess, is what we would call them. Meta at the top of the list today, up over 2%. Amazon up about 2%. Nvidia up about 1 2/3%. Someone mentioned it was down in the aftermarket on an announcement. For what it's worth, going into today's close, decent update for Nvidia. Now, I mean, what's interesting about a lot of these charts, right? Particularly Nvidia, Broadcom, Alphabet. A lot of these charts, Tesla, are testing key moving averages. They're testing the 200-day moving average. A lot of them testing key support levels. So great that they're all bouncing today off of that anticipated support. Most of these names are very close to a level where if they would break below it, it's hard to deny that those are now pretty bearish charts, I would argue, based on my assessment. So check out that video on the Stock Charts TV YouTube channel. It's my weekly show over there where we dug into each of these charts in a little more detail. I think I grabbed Meta's chart to dig into a little bit in today's episode. All right, so not a bad day, right? When you look at the high level, and also not a bad day when you look at the heat map. So we're going to transition to the market carpet on stock charts. I appreciate those of you tuning in live. We're broadcasting right now on Facebook, LinkedIn, YouTube, and X. Great to be back to the live broadcast. Great to see you guys asking questions and keeping the chat active. Any of those live stream platforms, any of those social media platforms, as we go, there's going to be a comment section where you can ask questions. I'm already seeing some questions, a bunch of questions on our YouTube channel. See someone tuning in from Facebook. Thanks for watching there. And thanks for the question here. We'll try to grab 1 or 2 at the end of the episode. Any of the ones we don't get to, we'll go into our mailbag. We had a really fun mailbag episode on Friday. If you missed that one, make sure you check that one out on our YouTube channel. Some really great questions from you guys last week, and gave us some great content to dig into in a little more detail. All right, looking at the heat map, I mean, overall pretty good, right? I mean, it's pretty clear that this was a positive day for the markets in the fact that some of the biggest names are in the green, right? When that's different, it's pretty stressful to the benchmarks, right? When those big names are down today, this is a pretty decent day all around. So a couple things. I mean, number one, great to sort of note where you're seeing kind of renewed strength. Some of these sectors have not been particularly strong as of late. So good to see them starting to resume a little bit. And I'm, right at eye level for me on my monitor is the financial sector. I mean, the financial sector has been underperforming pretty consistently here. Nice upswing for a lot of these charts. Are these charts great charts yet? I would argue definitely not, right? I don't think you could make a cogent technical analysis argument that MasterCard is a great chart. Is it not going down anymore? Maybe. I mean, that I think you can make an argument for, but I mean, we're potentially bouncing off of support around 500. So a lot of these names still, I think the charts are still chart challenged. I think we need more to indicate more signs of accumulation, but seeing some bounces higher in charts like MasterCard and charts like BlackRock, charts like Morgan Stanley. These have been in a pretty consistent downtrend, most of those so far in all of 2026. So I think interesting to note. Also noticing like Robinhood, Coinbase, these have been some beaten down names in the sector, also bouncing higher. So too early for me to say financials are now the new area of technical excellence. We're not there yet. It's one day, but good to see them in the green today is, I guess, my main point there. Elsewhere, we're seeing some strength. Obviously, the technology sector doing pretty good. Charts like Lam Research come to mind because LRCX is one of those charts that, it's really part of this breakdown, right? We had the breakdown below the 50-day moving average. We had this great bullish engulfing pattern that happened about a week and a half ago. That has led to a retest of the 50-day moving average. I mean, Lam Research, LRCX, really close to breaking back above the 50-day. I think that sort of unlocks a return back to those previous highs. We had the shooting star candle back at the end of February, right at the peak. Breaking the 50-day, I mean, certainly implies a retest of that as a reasonable upside expectation. But we have to get back above the 50-day moving average. And I would say that would be the general observation, in my opinion, with a lot of those technology names that have kind of broken down, maybe regaining their mojo. Let's get back above the 50-day. Good to see renewed strength from Western Dig and Seagate, STX. These are two like storage names. Western Digital back up to the previous side, and we're in the range of those high days back here. Remember on the chart of WDC, we have a number of these days that were pretty, had these long upper shadows or long upper wicks, right? So that basically means we traded higher but sold off through the course of the trading day. So what's interesting about a chart like WDC, we pulled back to the 50-day moving average. This one actually had a bullish engulfing pattern as it was testing the 50-day. Pretty encouraging when you have a candle pattern, a bullish candle reversal pattern as we're testing a key support level. That's kind of a perfect storm of short-term accumulation as it's testing the support level. So bouncing higher. So I think that's a pretty good setup. I mean, it's hard to consider Western Digital as anything but a very strong chart in a strong uptrend, strong momentum, strong relative strength. I think it checks all the boxes at this point. And at a time when a lot of charts do not, quote unquote, check all the boxes, I think the ones that do should be called out. So that's pretty good as well. So a number of names in technology. We don't have to go through all of them, but I'm certainly finding some encouraging charts there. And again, the fact that like WDC isn't breaking down below the 50-day is a good sign. And then let's hold on to the things that are still pretty encouraging here. Micron making a new high. I think I grabbed that chart, but let me check and make sure I did. Oh, I didn't. So let's look there really quick. Micron is another one of those, similar to like WDC with a successful test of the 50-day. Micron's actually testing a new high. Now, what's interesting about the chart of MU, and sorry, I've kind of zoomed out here pretty good. Let's do it right? It's my show. I'm going to take a moment. We're going to zoom in a little bit here. So you have this pattern. We have the big run higher, and then we have this pullback, and that's what we call a bull flag pattern, right? We have a big run higher, and then you have this move of lower highs and lower lows, right? So big move higher, and then this kind of downtrend channel, lower highs, lower lows on a shorter term time frame. So this is a really bullish setup if and only if we break above the upper boundary. And going into Friday's session, hadn't broken yet. So, I remember looking into Friday, I was like, all right, can we test that and successfully break out? Friday, we did finally close outside of that flag pattern. Today, with the gap higher, we're out of that. So the bull flag pattern, that confirmed bull flag pattern, pretty bullish at this point. I'd love to see follow through with a break above the January peak. We haven't quite gotten that done today because we sort of stalled out through the course of today's session. But I would say at this point, innocent until proven guilty as we broke above that upper boundary. Anything else on the heat map within health? I mean, so the other thing you can do on a day like today when everything was kind of working, focus on the things that were in the red, because anything in the red today means it is, sort of, going against the broader trend in the market. And so I think that's obviously something you want to pay attention to. In the communication services sector, it's not surprisingly the more defensive names like AT&T was basically flat, but like Verizon and T-Mobile both pulled back today a bit. Consumer staples did not have a particularly great day. Molson Coors down another 3.5%, testing a new 52-week low. So that's certainly a concerning rotation. Consumer staples had been one of the better places to be in January and February. March so far has been the opposite. It's been one of the sectors that's been struggling the most. So I would say today, charts like ADM, pulling back after a breakout, stocks that have been struggling like Molson Coors continuing to rotate lower. So that continues to be one of the worst sectors so far in March. And then finally, I would just note some of the breakdowns in the healthcare sectors, like CRL is Charles River Laboratories. That's a bit of a concerning sort of failed breakout above the 200-day and rotating back lower. It was, I mean, I had some questions on this sort of in late February, early March, as it's getting back above the 200-day, but now it's kind of rotating lower. And I'll tell you what this looks like. It's not a perfect example of this, but the moment I draw this line, you're probably going to get what I'm getting at. I mean, this starts to look like a head, topping pattern, right? A head and shoulders top. It's not a perfect one because the left and the right shoulders are not really even. And a classic head and shoulders pattern, the left and right shoulders are pretty consistent. There's a symmetry to the pattern, and usually the neckline sloping downwards is not ideal. Ideally, you'd want it to be flat or slightly higher is more of the classic pattern. With all of those kind of qualifications aside, I would say, certainly we break below that neckline. And I think that's undeniably a negative rotation. So healthcare, not the strongest sector at this point. And we can see some of those that are names that are struggling here in the red. Some of those had been breaking out, like HSIC comes to mind as a new 52-week high at the end of February, and now it's been pulling back in March. So March has not been great for a lot of healthcare, certainly for consumer staples, some of the other sectors as well. And energy for the first day in however long, not at the top of the leaderboard, right? With crude oil prices spiking, we've seen energy consistently at the top of the leaderboard. Today, not so much, sort of mid-range as growth sectors back at the top of the list. All right. Thanks for some thoughtful questions. I'm already seeing some questions and some chats, even a joke of sorts on our YouTube chat. So thanks for keeping it professional, everybody, as always. But great to see you guys making some comments and everything. We're going to get to some more charts here in a moment. Before we continue, I do want to take a moment and give a shout out to the sponsor of today's show, EPS Momentum. If you like finding stocks that have real earnings growth and momentum behind them, this is a tool I'd encourage you to check out. It's really designed to help surface companies with accelerating earnings, but also strong institutional buying. And the way they look at accelerating earnings is through earnings estimate revisions, which according to their research has been one of the more powerful drivers of long-term stock performance. For institutional buying, they look at price momentum factors like average true range, other technical indicators that I've reviewed. And I think it's pretty good. It's looking for stocks where both the fundamentals and the market action are lining up. You can find more information about this new product at marketmisbehavior.com/EPS. My link will also get you 30% off a new subscription. So again, marketmisbehavior.com/EPS. You get 30% off if you want to check it out, get a free trial as well. Also want to let you know I have a free webcast, as I alluded to earlier, coming up on Thursday of this week on the 19th at 1 p.m. Eastern at 10 a.m. Pacific, called From Model to Market, How Mindful Investors Evaluate Trends. We're going to be talking about my market trend model, how I designed it, what it's telling us, what it means that medium-term model turned bearish about a week and a half ago. We will talk about some previous rotations in the market trend model in a similar structure. We'll also look around at a number of other ETFs covering global asset classes. You can sign up for that free event at marketmisbehavior.com/model. I hope you'll join me for that free event coming up this Thursday at 1 p.m. Eastern. All right, shall we continue on and look at some charts together? Here's the daily chart of the S&P 500. Again, this is today's bounce. So before we get too excited about the action we saw today, we're still, I would argue the trend in this market is still lower. We're still making lower lows and lower highs. That's the mark of a downtrend. It is very easy, if you're just looking at one day session, to get super excited on up days and super negative on down days. That is why my process, a daily process of evaluating, action on a day like today, involves assessing the conditions today and then drawing them into the longer term implications, right? What was new today and how does that fit into the longer term thesis? And I would say the general pattern of lower highs and lower lows is what has me concerned. The good news is today's bounce means we are holding the 200-day moving average. The S&P below 6,600 means we're breaking below the 200-day. We've been above the 200-day since the April 2025 market low. So if that's unable to hold, we're running out of potential levels of support here. And I would say that's more negative. For now, encouraging that we're holding the 200-day. For now, the RSI is kind of right at 40. We broke below that on Thursday and Friday, which is a sign of concern that the RSI is generally below 40 on this pullback phase. If we can mount some sort of recovery rally here, support often becomes resistance. So 6,800, that's the lows from January and February. We'll see if that would be able to be eclipsed, and if not, I think this is still a downtrend phase after that breakdown below 6,800. Now, what are the breadth conditions telling us? I mean, one of the more encouraging things I'm seeing so far this week, and really through the course of last week, that while the short-term breadth indicators have gotten very negative, so percent of stocks above their 50-day down almost to 30%, which is a pretty low reading, the longer-term breadth has remained pretty positive, right? So percent of stocks above their 200-day currently still holding above 50%. That was one of the things that encouraged me to not be so bearish in November of 2025, is the fact that we still held this 50% level. And again, this is in the percent of stocks above their 200-day moving average. If that can hold again this week, it's good sign, great sign, right? That's a very encouraging sign that tells you that even though we've had some short-term price weakness, enough stocks are holding their 200-day. Things just aren't getting that bad. But a break below the 50% level there could be pretty negative. We'll keep an eye on that one for sure. Next chart is dealing with the Zweig Breadth Thrust. This is a market breadth indicator. There are a number of different market breadth indicators, breadth thrust indicator. A breadth thrust, if you're not familiar, is a pretty widely documented phenomenon when a market has been going down, and then the breadth is really negative, which is pretty common. When the market's going down, breadth is usually down as well. But then when you have the really negative breadth that flips really positive in a short period of time, that's called a breadth thrust, right? It thrusts back higher. And more often than not, it's actually a really bullish sign if you can get that breadth thrust. One of my premium members asked over the weekend if we'd had an initiation of the Zweig Breadth Thrust, which is a breadth thrust that was popularized by legendary market strategist Marty Zweig. And the answer is yes, we've had an initiation of that indicator. The indicator basically looks on the quick version. I might record another video going in a little more detail on this, but the quick version, just so you're aware, is you look at the percent of advancers on the New York Stock Exchange versus the total, and you do a 10-day exponential moving average of that total percentage. What you need to do is go from below 40% to above 62% within 2 weeks. That was the structure that Marty Zweig found to be pretty powerful. And so we have gone below 40%. We dipped below there in the latter half of last week, which means the clock has now started. Within 2 weeks, can we get a break above 62%? Now, what you have to remember is for that to happen, a lot of stocks are going to have to be moving up pretty quickly, right? Because you're going to have a lot more advancers than we've been seeing. So what happened today will have to happen a lot more over the next 2 weeks. So if the Zweig Breadth Thrust actually fires, usually by then the market has already rallied because the breadth has turned really positive and there's enough advancers to move the indexes higher. So the bull case would be confirmed with the Zweig Breadth Thrust logging a bullish signal. Last 3 times we've had a Zweig Breadth Thrust, and I've zoomed out. This is a 25-year chart just to show the history, but April of 2025 after the low, fourth quarter of 2023 after that October low, end of the first quarter of 2023 after that swing low coming off the October 22 bottom. So it doesn't signal often, but when it does, I've learned to not ignore it. So that's an indicator that we track. We don't talk about it often because usually most of the time it's not signaling anything. It might be firing. We'll keep an eye on this over the next couple of weeks. We'll certainly let you know. We'll make some noise here on the market recap show. So tune in, tell all your friends. We'll track that and other breadth indicators as well. All right. I don't get to run corrections very often, but I want to run a correction and a kind of apology to my good friend Tom Boley. I had a question in the mailbag on Friday. If you watched the episode, the question was the AD line, and I assumed that meant the advanced decline line. So I gave this great answer talking about, I'm not sure what Tom Boley was looking at because the advanced decline lines still look, pretty rough here in March. A number of you commented, and I appreciate you doing so and letting me know. He's probably talking about the accumulation distribution indicator, which is often also called the accumulation distribution line or the AD line. Horrible naming mechanism. And so I will now say Mark Jakin, boy, I wish you would have named it something differently so that it wasn't as confusing, because it's not the first time that there's been a confusion there. So looking with fresh eyes at that question, I think it's a fair assessment, right? The accumulation distribution indicator is similar to the Chaikin money flow, both designed by technical analyst Mark Chaikin, both looking at volume weighted by where the stock is closing on its daily range. So the accumulation distribution line actually tracks the trend in volume as weighted by the up and down closes. Chaikin money flow, similar methodology, but it does like a look back period. So it's like a 20-day look back over the last month. How strong or weak has the volume been as weighted by those directional moves? I think Tom's takeaway was the accumulation distribution line on the major averages, and this is the S&P, still quite positive, and that's true. I can't disagree with that. So I would say, out of all the technical evidence I'm looking at, what is still pretty constructive, the fact that the volume hasn't been dramatically negative is still pretty good, right? And so we've seen that with the accumulation distribution lines going up, with the Chaikin money flow still well above zero. Now, last week, the 80 lines actually rotated lower on the major U.S. averages. So while the trend is still up, starting to hook lower a little bit, and I would say that would be kind of the disaster scenario on this chart. The S&P breaks below the 200-day, the advanced accumulation distribution line continues lower. All of a sudden, seems like it's clearly not in an uptrend anymore. Chaikin money flow goes below zero. Those would all be pretty negative resolutions. For now, though, not too bad. So I would say Tom's on it, and I had no doubt Tom was looking at something that was probably true. There it is. So adjusting my answer to Friday's episode, and thank you, a number of you that pointed out I was probably looking at the wrong indicator. You're right, and thanks for that. Friendly reminder, your host is not perfect, as my wife often will remind me. All right, here's the chart of crude oil. I just wanted to highlight the fact, and this is through today's close, it looks like. So what's happened in the last couple of weeks, right? I mean, since the initiation or since the revelation of these events occurring between the U.S., Israel, Iran, and now more and more actors getting drawn into this conflict in the Middle East, crude oil prices have been going up. Any disruption to the flow of crude oil, while it may not directly impact our ability to fuel our cars here in the United States, certainly can impact things on a wider globally, because a lot of countries do get a good amount of their crude oil through, from the Middle East and often through the Strait of Hormuz, which we're now getting maps of rapid fire on a lot of news websites, and justifiably so. It is a big area of transit for a lot of global goods. I would say that higher crude oil prices, while they don't maybe directly impact prices in the U.S., they definitely will, for a couple of reasons, right? If crude oil remains elevated, anything that you get, any good that you get at your house or in your neighborhood is probably brought by something that uses oil in some way. A lot of products are actually derived from petroleum, right? Or sort of petroleum, derived. And so that's going to impact those sorts of things. And just the fact that a lot of companies have a lot of revenues coming from outside the U.S. So if their supply chains are threatened, that's just generally is going to make prices go up. So what's happening is crude oil prices have been trending higher. Now, what happened today? Wait for it. What is it? A bearish engulfing pattern. All right. I feel like at least once every episode, we've got one of these popping up. And so I'm happy to highlight it for you. Big up close on Friday, higher open today, just above $100 a barrel, close back below 94. So that's a bearish engulfing pattern. Suggests the next 1 to 3 bars on crude oil lower. I hesitate to draw any dramatic technical conclusions from crude oil at this particular moment, because it is a very headline-driven market. The moment one very encouraging or very discouraging headlines comes from the Middle East, this chart is going to evolve very rapidly. For what it's worth, though, I don't mind highlighting the evidence. Bearish engulfing pattern, suggesting a bit of a pullback this week in crude oil prices. They've been going up a ton, so not unrealistic to expect some sort of counter trend move at the least, even if you're all bulled up on crude oil prices. Bitcoin also going higher, and this is one of the changes we're observing now going into this week. Over the weekend, Bitcoin actually did manage to close back above its 50-day moving average. We had highlighted last week on the show that it had not yet done so. It did do that on Sunday's session, and now on Monday, we're moving higher again. We're getting very dangerously close to that 75K level. That's the level where I kind of set an alert and agreed that I would revisit a potential position in Bitcoin. I'll let you know what I come up with. But I like the fact that it's breaking out. I like the fact that the RSI is going over 60. That all speaks to improving momentum and improving price action, and that's encouraging. All right, I've hand selected some individual stocks, then we'll take a question or two before we wrap here for the day. Rapid fire here. Meta, again, I did a show on Stock Charts TV today where we dug into some of these charts in a little more detail. The idea was to highlight, key patterns and key levels. I think the key level on the chart of Meta is 600. That's this level here. That's actually a Fibonacci level. That's also the January swing low, almost exactly at $600 a share. Today, Meta gapped higher on news that they were going to be cutting about 20% of their workforce. And essentially, we've been talking about this issue that companies like Meta are spending an absolute insane amount of money on AI infrastructure. And so what does that do? And so now we're actually seeing a big tech company, after spending cajillions of dollars on AI infrastructure, with its right hand, with its left hand, is jettisoning 20% of its workforce. Now, I'm based in Seattle, Washington, which is where Amazon and Microsoft and a bunch of other big technology companies who have also been spending a lot of money on AI infrastructure, if they would follow suit, I mean, there's been huge growth in these companies and they've been on hiring binges. Now, all of a sudden, it's the opposite. We're starting to see now that could be an interesting data point if that would actually play out. For what it's worth, Meta, after gapping higher, actually closing more toward the lows of the day today. Freeport-McMoRan, FCX, is one of those mining stocks having a bounce today. FCX has been going down so far in March after testing its previous all-time high around $70 a share. March so far has been more weak, and we've gone below the 50-day moving average. We're starting to bounce off of that 56 or so level with today's rally. Last week, we bounced off that level as well. That's a 38.2% retracement of the way back down to the September swing low, which is the bottom of this big basing pattern. So potential support level. If that would break, all of a sudden we have a lineup here at the 61.8% level, right around $48. The 200-day moving average is down there as well. So I think of that as, if 56 doesn't hold, that could be the next downside objective. Would be a pretty rough go for Freeport-McMoRan. SNDK ticker is the ticker that's in SanDisk, very similar to the chart of MU. Right, I just want to highlight MU. Micron is not the only semiconductor name with this sort of bull flag pattern. Both of these confirming that bull flag breakout. I was going to say, I remember a chart looking just like that one, but it wasn't Micron. It was SanDisk, right, which is almost the same pattern here. But look at the uptrend. Look at the pullback of lower highs and lower lows. Bullish engulfing pattern about a week and a half ago. As we rotate higher, we've now resolved that bull flag pattern to the upside. So I think both of those names, while not all semiconductors look amazing, those two definitely do. I did want to highlight some of the earnings hits. We have Ulta Beauty, which gapped lower. They actually reported earnings last Thursday, gapped down on Friday, and then continued lower. Closed below the 200-day moving average on Friday's session. When you have that sort of move, I always look for confirmation. I think we got it today with Ulta again going lower, so down another 3.5%. Earnings miss continuing to get weaker. That's a challenge. All right, I see some questions about the Zweig Breadth Thrust, about the Hindenburg Omen. I appreciate that. I'll answer this question. Bullish is the signal that takes Hindenburg off the table. Oh, this is after I was showing the Zweig Breadth Thrust. So I think your question is, does that mean the Hindenburg Omen is off the table? 100% not. That's a great question. Does that mean the Hindenburg Omen is off the table? I mean, I would say the Hindenburg Omen, by definition, speaks to the fact that we have a major corrective move ahead of us. That's kind of what, when the Hindenburg Omen flashes, that's what it implies, right? Other major tops have had that. Have we had enough of a pullback on the S&P 500 that I would say, yeah, the Hindenburg Omen has now been validated by the fact that we've gone down a ton? Like, no, we have not gone down a ton, right? We're still even above the 200 days. So I would say the Hindenburg Omen has not followed through on my expectation of what it usually means when the Hindenburg Omen fires. A Zweig Breadth Thrust, yeah, would make me a lot less bearish, because there have been very few times, you can look at that chart that I showed earlier, there have been very few times in history where we've had a bullish Zweig Breadth Thrust and we have not been higher 6 to 12 months later. I don't know if it's ever happened, to be totally honest with you. I would guess the 12-month returns after a Zweig Breadth Thrust are remarkably strong. So while that can mean we have some choppiness, there have been times when the Zweig Breadth Thrust has led to a new low in the short term. The next 6 to 12 months have almost always, if not always, been higher. And so Yeah, that would tell me that a Zweig Breadth Thrust would basically tell me if we have further downside, I need to start thinking about buying weakness and not selling weakness. At this point, I'm still in the get defensive mindset. Great question though, and thanks for that. My initial gut action was to say, of course not, but now that we're talking about it, yeah, because I think that would be a really interesting new data point that would tell me something new. Right angle triangle. I love your handle so much, and I appreciate your questions. You always bring some good ones. You come to play every day. I appreciate it. Nvidia, today's candle looks negative for the GTC conference. Do you consider the trend to be neutral? Thanks for mentioning that. My goal is not to get too much into conferences and things and that news flow. I'm assuming you're seeing that from other places, but for what it's worth, that is a potential market moving thing happening this week. We'll see what comes out of that, but that's a big conference opportunity for them to, make a case, or for investors to derive some sort of bull case. The chart of Nvidia. Just look at the candle chart and just look at how many times we've kind of traded up into the mid 190s, and how many times we've had these bearish candle, like these big dark candles off of the high, right? And that just speaks to the distribution. The selling that happens when we've gotten up to that level. Your question is, does this mean anything in particular? Not really. Is this a really classic candle? It really isn't. You could really force it and say it's some sort of like shooting star kind of thing, but it really, I would argue it really is not. It's not a great example of any candle. If I was writing a book about candle patterns, I would not include this example for anything right here. Because what's happening is you've got the open and close very, very close. You have this big upper shadow, but you also have a decent lower shadow. The closest thing, this is almost like a doji candle where the open and close are identical, but it's not quite that. So I know. Does it mean something that we traded all the way up here and then close back down here? That's not good. And that's not a candle pattern. That's just looking at the sentiment during the day, right? So instead of regaining the 50-day, that would be optimism, closing back lower. So we rallied above the 50-day, and then at some point, people started unloading after we rallied high. I think that's more the story on the chart of Nvidia today. Hey, awesome questions. I see a number that are interesting, but we're out of time. I'm going to put those in the mailbag, hopefully this Friday. We'll include those in the show. In the meantime, thanks for tuning in live, those of you that did so. If you're watching on our a replay on our YouTube channel, hey, you just use the comment section there, and we'll look for your questions as well. In any case, thank you so much for joining me on the show. I hope you have an enjoyable evening. And remember, it's always a good time to own good charts. Take care, folks.